Hello, welcome to Strictly Money, where all voices matter. I'm your host, Saijal Patel. 2022 has no doubt seen its share of challenging headwinds, from stubbornly high inflation to market corrections to a housing downturn and even a jump in unsustainable household debt. Well, my guest for this show says, looking ahead to 2023, there's a reason to feel a bit more optimistic. Phil Petursson is Chief Investment Strategist with IG Wealth Management, and he joins me now. Hi, Phil. Great to have you back.
Thanks for having me, Saijal.
I read your report. This is your 2023 outlook, and you believe that when it comes, at least to the markets, we're close to bottoming out. So bad news priced in now?
That's what we believe. Now, we have to temper that with expectations of a recession coming next year. The economic data is fairly clear in that with respect to an inverted yield curve, with declines in housing that you mentioned, higher inflation. All of the typical signs that precede a recession are present, yet we have to ask ourselves how much of that has already been factored into the current market environment. And we would argue, I would say 70 to 100% of it could already be in the market. And in fact, we may have seen the low point for the US equity market, Canadian equity market, and others around the world in October. And so we are a little bit more optimistic from the market perspective, as well as not only equities, but fixed income into 2023, even with the headwinds of a recession in front of us.
So what is the market telling you then, Philip, in terms of a recession? Is it pricing in a mild one or something a little bit more severe? And what do you believe?
Well, it really depends market by market. If you look at valuations in Canada, in Europe, and in the emerging markets, we would argue that valuations are consistent with what you would see during the bottom of a recessionary process. And so that would lead us to believe that in these areas of the world, we are fully priced in with respect to economic risk. In the United States, valuation is still a little bit higher than would be typically normal for a recession. But that's not to say that it's expensive. The US equity market isn't expensive. We would just say that it's not reflecting the same type of trough valuations during a recession that we would see, for example, 2009 or 2002. So the upside in the US might be a little bit more muted next year as opposed to international equities.
Okay. And when you talk about valuations, what kind of numbers are we looking at?
Well, I like to use trailing earnings right now only because the analysts are still a little bit too optimistic in their forward earnings expectations. When we look at that, the US is trading about 19 times trailing earnings. Canada is trading about 13. International equity markets overall are about 12 to 13 times. And the emerging markets are at 11.
Oh,
when
wow.
you look at Canada, exactly.
Yeah.
You have the emerging markets that are trading at a deep discount relative to where the US equity market is. And that leads to this more optimistic view, international versus US.
Okay. So when you're looking at a diversified portfolio, for those viewers that are watching, it might be a good time to get some exposure into those emerging markets. Phil, would you say that it's a stock pickers market? And I ask that because it was not too long ago, and there was a lot of talk that value stocks were where you want to be. I'm wondering if that's shifting now to growth stocks.
Well, I don't think so yet, because in order to shift to growth stocks, you need growth. And what we know going into a recession is that growth is going to be scarce. So I do think that when you describe it as a stock pickers market, I think you're spot on. I think you want to be very selective with what you're buying. You want to be aware of not just the valuation, but what you're getting out of the company itself. So I don't think it's just pure value without any type of sustainable profit growth out of a company. But yes, less growth, more value. But I also would say that is an asset allocators market. So what we've seen in the past year and a half is that correlations for equity markets and fixed income markets were trending at one, meaning everything was moving in the same direction. But I think into 2023, you're going to see a lot more deviation of performance across asset classes as well as geographies.
Okay. Yeah, and that's an important point. We only have 30 seconds to the commercial break because I was going to ask you about bonds. They've been down as well. So you could see that divergence. Is that what you're expecting now?
Exactly. I mean, it was a terrible year for bonds because interest rates shot up as much as they did, that no one had expected. But where yields are today sets forth a more optimistic outlook for bond returns, not only in 2023, but the next number of years.
Okay, we'll take a quick commercial break. Lots more to unpack. Stay with us. Welcome back. Philip, you were talking about bonds and asset correlations, and that there could be some upside coming back in the bond market. Now, we know that bonds are tied to interest rates. How are you reading the yield curve? What is it telling you now?
Well, the yield curve is very much inverted, meaning long-term interest rates are much lower than short-term interest rates. But that's a reflection of the market expectations for rate increases out of the Bank of Canada or out of the Federal Reserve. I think we've seen the widest that we're going to in terms of the inversion of that yield curve. And over the course of 2023, we should start to see that yield curve flatten out again. And how that's going to work is that shorter term bond yields should start to come down as expectations of the Bank of Canada being done with its rate increase starts to be priced into the market. So long-term bond yields, the 10-year yield and further, even I would argue the 5-year yield to an extent, are likely to be anchored around their current levels. But it's the short-term bond yields that are going to start to fall and then push that yield curve back into a positive slope. What this is saying is that it's going to be a better year for bonds in 2023 and beyond than we saw in 2022, which was the worst year that we've seen in my career, or perhaps in the last 100 years.
Yeah. What does it mean then for the rate cycle? You mentioned looks like it's pricing in the end of it. Certainly seems like that from the tone that we're getting from at least the Bank of Canada. Are we close to the end of the rate hikes?
We believe we are. We believe that we've seen a peak in the interest rate cycle, or are very near it within, say, 25 to 50 basis points for the Bank of Canada. Similarly for the U.S. Federal Reserve. So peak in interest rates, peak in inflation at the same time. And so the work that the Bank of Canada has done through 2022 with raising interest rates, trying to slow inflation down, is having an effect, and will continue to show that through the economic data in the first half of next year.
Okay. And yeah, you're seeing, that means they have to believe that the interest rates has actually curbed demand. And you're seeing that reflected in, say, retail sales and investment?
You are. You're seeing it mostly in Canada in the housing market.
Yeah.
The very, very sharp declining housing prices, housing activity, investment. So what the Bank of Canada has done with raising interest rates as much as they have is having an effect. And we'll continue to see it. Now, the impact by raising interest rates tends to take anywhere between 6 and 18 months. So what we've seen out of the Bank of Canada this year really still is only at the start of being felt in the economy, but it'll continue to permeate through at least through the first half of 2023.
So you don't think they've overshot then? Is there a risk of that?
There is a risk of it, but as the central bankers have said, and I agree with them, they would rather overshoot because it's easier to cut interest rates than undershoot and try and rein in inflation that might be running hot.
Okay. Now, Philip, you're in the camp too that we could see a recession next year, but you're not expecting a deep one. Why is that?
Well, because this is going to be, this is a recession that's been triggered by different factors than what we saw in 2008 or what we saw, say, in the early 80s. Typically, a recession comes about by a buildup of excess in the marketplace. And we've had that to an extent in terms of all of the money that got into the economy following the COVID lockdowns. That was necessary, but it wasn't for an extended period of time. And we measure this through the money supply increase in Canada, in the United States, and around the world. It was like a one-time shot to economies that has since then dissipated. And so we don't think that because this has been a very truncated expansion from March to June 2020 to where we are today, this is going to be, I think, a truncated recession as well. The worst recessions tend to come with some type of financial calamity or collapse. Well, we don't see that. The banks are very, very healthy. Credit conditions are quite fine. in the United States and Canada. It's just interest costs are higher than we've seen for a number of years. That's just going to slow things down. I really describe this almost like the hangover from a very, very big party that we just celebrated in 2021, but it shouldn't be bad or extended.
Okay. Just 20 seconds to the next break. Employment picture still looking good to you?
For now, but remember, what the Bank of Canada is trying to do is slow down inflation, and I think they're focused on wage inflation, and so they would like to see that unemployment rate take up, perhaps from 5.5% to 6.5%, just to make sure that we don't see extended wage pressures.
Okay, we'll take another quick break. We'll be right back. Welcome back. I'm here with Philip Petursson, Chief Investment Strategist with IG Wealth Management. Philip, you mentioned the credit piece that is actually looking okay. We hear a lot in the news that household debt is creeping up. People are dependent on credit cards more than ever before. Obviously, a lot of worries about people's mortgage and the ability to pay for that. How big of a risk is that to the economy?
Well, it is a risk to the economy. When we mention credit conditions, there's two elements to it. Is it corporate finance? And corporate finance is fine and healthy. But then, as you point out, there's the consumer side to credit. And when interest rates go up as much as they have, those individuals that are renewing a mortgage today are renewing at a higher rate. So their mortgage payment now is higher. Anyone that has a line of credit, your interest costs are higher. This will have an impact on the Canadian economy. It should slow down consumption. I think we're seeing it in pockets of the economy, certainly in housing already, we're seeing it, but that can then work its way to other areas. And this is the nuance and the difference between what we could see in Canada from an economic slowdown versus the US. So when we say milder recession, in general, we're talking about the United States, but in Canada, we could see greater pressures because housing is such a significant part of our economic growth. Mm-hmm. And the way that we finance our mortgages isn't with a 15 or 30-year fixed as it is in the United States. So anyone with a 30-year fixed rate mortgage in the US is fine. Interest rates don't impact them. But here, if interest rates stay where they are, everyone renewing from here to the next 5 years are renewing at a higher rate, which means their monthly mortgage payment is going up. And that money has to come from somewhere. More than likely, it's coming out of consumption.
Yeah. And, you raise a really interesting point, Phil, because with the housing market, I'm seeing a lot being written about it, billions or multi-billion dollars of wealth being wiped out. And we know that that's on paper. Nothing happens until you sell your home, but it does play with the investor or the average person's psyche, doesn't it?
It does. We call it the wealth effect. If you see the value of your assets move up, there's a greater propensity to spend because you believe you have the wealth behind to basically cover those costs. And there's an inverse or an opposite to that. If you see your housing prices fall, then you don't feel as wealthy. You're less inclined to spend. So yes, psychologically, it will have an impact.
I want to ask you a question about sort of Main Street and Bay Street or Wall Street divide, because certainly, the average person is paying through their nose for pretty much everything. And there is a narrative out there, Phil, right now that this is coming at the expense of corporate greed, that companies are profiting and the average person's paying for it. How do you read that? Do you buy into that?
I don't think it's quite as pervasive as a headline might suggest, but I also have to look at the data and say, yes, there is an element of that too there. If you look at, for example, the earnings results out of the publicly traded grocery stores, they had very, very strong results in the last quarter, which tells you they're not absorbing the cost increases and seeing the impact in their margins. They're passing on those increases, perhaps plus some. Is it all coming from efficiencies in their operations? Perhaps not as much as we want to believe. So I would say that there is an element of taking advantage of the situation and passing on costs that maybe they were absorbing in the last 5 years, but passing on more costs, disproportionate costs to the end consumer. And yes, in pockets of corporations, you are seeing that.
Do you think that prices at these levels then are baked in? You know, food is supposed to be volatile. That's why we have XCPI. But, you know, there's little things that happen, like companies have changed their packaging sizes, you know, consumer staples. I often wonder, you know, what is the chance of the price of a shampoo actually going back to 2021 prices?
Well, I don't think that we'll see deflation. I think we
Mm.
can put that out of the mind. But disinflation, I do think that we will see, which means a much slower pace to inflation over the course of the next year. I think is very, very realistic. In fact, I think potentially by the end of 2023, inflation in Canada and the United States could be somewhere between, say, 3 and 3.5%. So much lower than the 7% that we're seeing today. But I shouldn't or I wouldn't suggest that we're going to see prices drop.
Okay. Yes. So we could see these prices stay where they are. Okay. We'll take another quick break and we'll be right back. Philip, what lessons have you learned when looking back at 2022 and things that maybe as viewers we should pay attention to?
Well, the first one I would say is that things are unpredictable, that the market, despite all of our work, and as we came into 2022, we did have a more modest view of equity market performance, but we weren't predicting a bear market in US equities or declines on a year over year basis. That said, though, it is always look for the better relative opportunity. And so some of those opportunities did open up, and we're seeing those bear fruit now, which is if the US is the more expensive area of the market, rebalance into Canada, into international, into the emerging markets. And guess what? You know, even though these markets were down this year, they're down much less than the US. So there's still asset allocation opportunities to take advantage of. And while we can't predict the day-to-day moves, you can better your position going forward.
Yeah, I want to come back to the TSX because it has been an outperformer. And part of the reason for that has been because of commodity prices, but particularly oil prices. What's your view on commodities then?
Well, we think that oil prices are going to remain fairly stable at the current level. So let's call it around $75 a barrel. My target over the course of the next year is 75 up to about 100, maybe 110. So we've actually eased off on our oil price target over the past year, brought it down a little bit, just in recognition of a weaker global economic environment that will curtail some of that oil demand. Mm-hmm. But we shouldn't expect oil prices to get back to $50 a barrel because supply is still very, very tight. That should mean a still decent year for the TSX. In fact, I think the risk is to the upside, not because of energy, but because of valuation and some of the opportunities in other sectors of the TSX outside of oil and natural gas.
So what other advice would you give to viewers when it comes to managing money? Diversifying, certainly one of them.
Absolutely. And don't let what happened in the last year drive your investment decision for 2023. There's a lot of bearish sentiment out there, meaning people are very nervous as we go into 2023. And I think largely it's because of what we've just come through. And it's a little bit more investor psychology, that when we have a loss in our portfolio, we actually forget about the gain opportunity in front of us. And all we do is focus on the loss, but that can lead you down the path of missed opportunity going forward. Meaning if people are selling and going into cash today, then, and not recognizing that bond yields are the best that they've been in almost 20 years, or equity valuation is the best that it's been in almost 20 years, you're really missing out on the upside risk that could surprise us in 2023.
What do you make of the FTX debacle? And I ask that because we've seen, you know, risk off with crypto. Do you see that spilling into investors' psyche when it comes to just regular, you know, broad-based asset classes?
Well, you're hearing it a little bit. Investors are wondering what is the spillover effect of an FTX and could that lead to other types of collapses that spreads into regular asset classes or more common asset classes like equities and fixed income? My view is no. The whole crypto market is still very, very small. It's about 2/3 smaller today than where we were at the beginning of the year, but it's just a fraction of the global equity market, and it's a tiny fraction. So I don't think there's as much of a spillover, but it does stoke the fears in the investor's mind. But this is, I would say, a little bit more of a fringe asset class, not a broad-based asset class that exists in certainly the portfolios that we manage. So it's something that we read about in the news, catches our attention, but more headline risk than actual market risk.
Okay. Only 30 seconds left. What's the biggest challenge or headwind you see in 2023?
To be honest with you, I think the biggest challenge or headwind is going to be investor psychology. I think the recession, whether it actually comes to fruition or not, is largely well known and I think priced into the market. We know earnings growth is going to be down across many companies, but that's actually quite normal, through the cycle that we're going to go through. And what we've come through in 2022, again, shouldn't drive our investment decisions in 2023, thinking that things have more downside than upside. We could always be surprised, but I would say, don't forget about asset allocation and the risk to the upside.
Okay, Phil, thanks for coming on. Happy holidays and Happy New Year.
Likewise, same to you.
Well, that wraps up this edition of Strictly Money. I wish you and your family a very happy and healthy holiday season. We'll see you back here in the new year. Thanks for watching.